JPMorgan may be in some hot water. When the New York-based bank knew federal authorities were investigating Millennium Health LLC, that is the largest drug testing lab in the U.S., it said nothing. That kind of omission would, in most markets, be regarded as unethical or perhaps illegal. Bloomberg's Laura Keller reported the story. She joins me now. What obligation legally was JPMorgan under to pass this information on?
Well, we've reported that JPMorgan felt it was not under an obligation to do so. What governs these loan agreements, especially when they're sold for the material omissions, is, more statutory law, common law. It's not, there's no SEC enforcing, you've got to disclose this has to be there. It's very much Wild West.
Is it standard practice that if the company says this isn't material, the bank is under no obligation to think about whether it should decide whether it's material or not?
Well, I mean, the bank is hired as an advisor, right? Yeah. And they deal with these lenders from deal to deal to deal. Yeah. So while maybe there isn't a legal mode for them to have to disclose it on behalf of the company, even if the company doesn't want to, certainly, there's an onus on them to maintain a relationship with lenders who are going to continue to buy a deal. Right. And if those lenders can't trust the agent that's hired for its expertise in marketing the deal, that becomes a bit of a problem in sales, right?
Yeah. Well, this is a great story because you really actually went into the broader scale here. It does seem like that this is a low interest rate environment phenomenon.
Yes, it's partly, lender protections go away when companies can just sell whatever they want to sell. This company, for example, this is a dividend deal, right, which is a risky deal to begin with. It was 75% of the proceeds used for a dividend, which essentially means you as a lender gave the company money, and the company took that money and gave it to its shareholders. It's a riskier thing that a lot of lenders don't usually want to do.
In the restaurant industry, they call that a kickback.
I think there are different names in different industries. It's usually...
That was very nicely handled. You really did that well.
Thank you.
Walk through some of these other conditions. When you talk about the Wild West, I was shocked to read in your piece blacklists.
Right. Yeah, we've been writing a lot about these blacklists. This is not something you can do in an equity market. This is not something you can do in the bond market, where you're public, people can buy, you and I, we can sell, we can buy it when we want. In the loan market, you actually have the company able to say, well, look, we don't want these kind of people in. Sometimes, it's for reasons you can understand, where it's a competitor. You don't want them to get your projections, and that's what lenders get. But other times, it's to keep out people I usually report on, which is the distressed debt world, because they end up sticking up for creditor protections.
But really, the reason that lenders are willing to accept these conditions is that this debt is what there is to hold. This is where the returns are right now.
Yes, exactly. And this is more of a high yield sort of situation, right? It's a loan, but it pays pretty well for a loan. So I think some people would argue for the risk that's there now, it doesn't. But at the time, that seems to be an attractive interest rate. And it was actually bumped up at the time of the sale, too.
This is what you hear across markets. We had no choice. We had to do it. We needed yield.
We needed to put our money somewhere, right? So these are the opportunities that exist. We exerted a little bit of control over the issuer. We got a better interest rate at the beginning. But now we're faced with all these problems. We don't know what to do with this company anymore.
Right. So you were sitting on all this cash. This is the nicest mattress in the guest house. When rates change, do we expect, has anyone told you that some of this behavior is going to go away?
I think it naturally starts to dissipate, right? Once you have more control as a lender, it naturally has to dissipate.
Okay. Anybody else? Who are the companies that are actually, from the filings that you've read, actually involved? There is a legal action, right?
Well, no, there's nothing filed at this point, but we've reported that the lenders have formed a group. They're trying to figure out, what they want to do going forward. You can start to think about declaring a default, looking at the loan document and saying, what did you as the company need to disclose? Did you violate this? Are you in technical default?
And if this is not an SEC action, it's a statutory law action, does this end up in New York courts?
I think the New York court is what governs this. It's literally, you could be governed by Delaware law. It just depends. I'm not sure where theirs is.
Okay.